Hello, welcome to Credit Careercast, brought to you by Highako. Today, Bob and Dave talk about managing your AR portfolio and how to avoid automation pitfalls. We hope you enjoyed this conversation. Let's get right into it.
David, this is a really interesting topic in my view. How do you manage your AR portfolio in the kind of turbulent and unpredictable economy that we have? A good time of the year to think about it, because you have to plan for the new year and maybe make adjustments. In my view, there's so many moving parts. I mean, you've got the economy, inflation, an increase in borrowing rates that can impact a lot of smaller companies who might be in your portfolio, where they were very creditworthy in the past, but now they have difficulty with cash flow. Their expenses are rising. They can't go to a bank and increase their credit lines. Their borrowing is more expensive. And then we've had this disruption in supply chain, which to some degree still plagues us. So if you're looking at an AR portfolio and maybe you're selling to different channels, distribution, manufacturing, dealers, retail, you're looking at your portfolio and you're saying, wow, and different regions of the country might be affected in different ways. Other countries you might be exporting to are impacted by all of this. So there's a lot of moving parts in a portfolio, but you're responsible as a credit manager to figure that all out and bring some predictability to it. So it's a huge challenge in my view, and probably more challenging than it's been in a long, long time. So what we want to do today, I guess, is talk about, okay, how do you bring some sense to all this? How do you bring some structure to how you manage your portfolio? And just kind of compare thoughts on, gosh, if I was in that seat, what would I do? So Dave, why don't you start it out and we'll just have a conversation about this and see how it goes.
But before we get into it, I've got a few more thoughts though on the situation that we're coming into. For one thing, I don't think it's going to just be small businesses. Corporate debt is at astronomical levels, and that's, of course, the Fed has had an easy money posture for more than a decade, and now all of a sudden they're raising the rates on it. And so we have a lot of companies that have leveraged debt on their books. I was just reading an article over the weekend. There's something like 200 public companies that are considered zombies. Their debt, paying off their debt, they're spending more money paying off their debt than they make in profit. And some of these are big names. I think GM was on the list. And so we have that there. We have, of course, the COVID recession, which was short-lived, but that's because of all the money that was pumped into the economy. And so when COVID hit, we saw about 5 million small businesses disappear. And we saw about 5 million new businesses come into being. And this wasn't through bankruptcies. These companies just simply liquidated and disappeared. And of course, many people probably just restarted the business under another name. We haven't had a lot of business failures in the past 2 or 3 years. And normally you can take a look at Census Bureau data and things like that. Normally you see 20 to 30% of businesses that have been in, that are started within a year go out of business. Well, that hasn't happened yet. And so I think as we move ahead, the seeds are set for this to be, and you made the comment, maybe unusually difficult. And so it's going to be a rough time ahead. And I think it's well worthwhile that credit managers be prepared. So, where do you start for that?
Well, I think you start at the very beginning of your process in credit management. When you originated your credit lines, there was an assessment of, the creditworthiness, but it starts with, what is your credit policy? How does your credit policy pace the strategy, the marketing and sales strategy of your company? And this could be very dynamic now because your company's obviously trying to retain or gain revenue. It's shopping for a customer base, and your job is to see how reliable that customer base is. And there has to be some mechanism to evaluate that. So I think it starts with a coherent credit policy that understands, particularly as you're planning for the coming year, what is the goal of your company in terms of who are they going to sell to? Are they going to, what channels of sale are they going for? This is driven by what the profitability is versus the risk. But you start with a credit policy that embeds the strategies of your company. I think it's where you start. So,
well, I think it starts with the strategies of your company. I'd back it up, before I start looking at credit policy, because you have an AR portfolio and you have various risk classes in it. And I think you need to get together with sales and you need to find out what their forecast is for each of those risk classes. And that's where you're going to start to put policy together.
Exactly, Dave. We're on exactly the same wavelength. But I think a lot of credit policies are dusty on the shelf, haven't been reviewed, and it's not something a credit manager could or should do in a vacuum.
Absolutely not.
The point is, you need to reach out to understand what is the cash forecast. And you pointed out, who are we selling to? Make sure that if the forecast is for you to sell into a certain segment of your customer base in your portfolio, what are the credit lines of those customers? What should they be? If they need to be higher than you're comfortable with, it's time to figure out ways of securitizing those customers, or telling your salespeople, it's a two-way communication, telling them, look, these are companies we should not be focusing on. We should be focusing on others that are more creditworthy and are going to actually have the ability to pay their bills and not go into some form of bankruptcy or whatever. And that really is a two-way communication process. And that's how you develop your credit policy. Dave, I think we're saying the same thing, correct?
Yeah, no, it starts with sales, and sales needs to understand where the risks are before they start doing their forecasting. So or else they're wasting time to try to sell to people that you can't extend the credit to, or you're going to only be able to do a limited amount of credit to them. And obviously with a recession, what you're facing two things. One, you're facing either a slowing growth of sales or slowing sales in real dollars. We're in an inflationary environment too. So, in real dollars, sales could be up, but in real dollars, sales might not be as high as they were. And then at the same time, you're going to have people trying to extend credit or paying you slow. And so the receivables are going to rise at the same time. And those two things are going to impact your cash flow. And so your job as a credit manager is to really protect that cash flow, because that's where companies get into trouble. Plain and simple, it's cash flow is the largest cause of bankruptcy, insolvency, and that type of financial distress.
Yeah, and kind of embedded in what we're talking about is, and you raised a great point. I mean, collectability in the coming year is going to be different than it was in previous times. So you may want to take a look at how you staff your department and how you're going to accommodate maybe more pressure on collections. And do you have the staff, the automation, whatever you need, the tools to do that effectively going forward? And that really, in a broad sense, really impacts how you manage an AR portfolio. It's not a static thing. It's a dynamic thing. The other thing I have always advised my companies I've worked for and my clients when I've consulted is understand the profitability by customer or profitability by channel. And you may find that there is maybe a huge huge segment of your portfolio that, a very large retailer, for example, who might be very slim on profit, but the sales and the income you're getting from those sales, you're not gonna stop doing business, because their overhead absorption, if nothing else, even though you're not making a lot of profit, it's keeping the lights on, it's keeping the plant full of employees. But then you take a look at smaller companies, maybe, or even like you say, Dave, even some name brand companies on down that are a higher risk, but they're not profitable for your company. So you really need to have a serious conversation with your colleagues in sales, marketing, and finance. Why are we doing business with them? Why is it? And there could be segments of your portfolio that you just don't want to do business with. Maybe you want to offload, direct sales, maybe to a distributor. They're very adept at dealing with companies and maybe better than yours. So, when we talk about managing a portfolio, I think those kind of issues should be addressed as well. What do you think?
And you have to get very granular with that too, because part of it is sales is going to say, okay, we're going to do a promotion, and they want to do it as a blanket across everybody. And you've got to say, no, we're barely profitable with these companies. We do a promotion with them. We end up spending more time resolving the deductions and the disputes than it's worth. And do we really want to be doing promotions with everybody? Well, they should be picking who they're going to be doing the promotions with, so they're going to get the most value out of those. And so it, gets into things like that, we don't necessarily think of them as credit, but it all affects the bottom line. Credit's job is to make a profitable sale and to ensure that. And so we've got to talk to sales about these things.
Yeah. So,
and the CFO is going to listen to those arguments.
Oh, yeah.
Even if sales doesn't want to.
Absolutely, because they have that visibility and the need to manage the inflows and the outflows of the company. When we're starting at kind of a granular level, like you said, we're starting at the customer level. So, you have to do a credit assessment. That's what we're talking about. You have to really understand, what is the amount of risk that I'm dealing with? How significant is the receivable from a particular company going to be? And what's the probability of default? What can be recovered in a liquidation realistically? What are you going to recover if they end up in a bankruptcy or some other form of liquidation? You got to think about things. If you're international, what foreign exchange risks do you have? And the other thing is, and I always did this in my career, actually, where you're looking at companies in your portfolio that maybe have seasonal issues, where they bulk up in October, November, December in your AR, and in January and February they had weak sales, and you either have to retrieve inventory if you can, or that's when they go into bankruptcy because they have too many obligations and not enough cash flow. So you have to look at that, and as you're selling to them, manage your exposure so that your profit on sales is always greater than your exposure. You need to look at a time horizon. And in some cases, you actually plan for that. You say, okay, I know that in February, there's a strong likelihood that they're going to be going into a bankruptcy situation. If I can sell them, 20, 50, $100 million in sales and make let's say a $15, $20 million profit, if I keep the outstanding balance below that, then I'm net good, and I've made sales, and my profit is greater than my loss. So I think you have to look at the kind of a time horizon of risk, and adapt your credit line and your collection approach based on that.
We've talked about the need to do the sales forecast and then to do a portfolio analysis. And then we need to take those two together and model it. And because we need to look at the cash flow, both the cash flow, what's that going to do in terms of cash flow for the company? And then what's going to happen to our AR as a result of that? And as you said, you need to look at this over a time horizon. And it's going to bring out some very interesting issues as you do that. And I think it's going to help you then fine tune, both for you and for sales, what your ongoing strategy is. It's not necessarily going to stay the same, so you're going to start at a certain point, but then as events go on and as things happen and develop, you're going to have cash flow is going to be X, AR is going to become moved to X plus 3 or something, and and sales is affecting that. You need to monitor, as you said, over time. You need to be monitoring this, and you need to be ready to adjust, because that's the one thing with the recession. You don't know exactly what's going to hit. We've seen it. Where the supply chain interruptions going to show up, what new ones are going to possibly show up. We were able to predict some of them last time. But we certainly didn't predict all of them. Who would have thought baby formula? But things happen. A plant gets decertified, and all of a sudden, whoops, there's a shortage. So there's things like that are going to require us to, take a look, at sales, at credit policy, at the AR, and at the cash flow as things continue along, and we need to make adjustments. And the cash flow is information that the controller or CFO are going to need to go back to the banks to manage their credit facilities. And with COVID, everybody draw down their credit facilities as much as they could. They didn't know what was going to happen. Let's get as much cash on the books as we can, because we can always decide later what to do with cash. I'm not certain that you might not see that type of thing happen again. As things happen, now you can put money in cash and you can make 4% on it, which couldn't happen last time. So the whole dynamics are going to change, and we need to, understand what the CFO is looking at doing, and bring this whole thing together, and it becomes an ongoing modeling process, I think, between credit, sales, and finance team.
Yeah, Dave, you brought up a couple of interesting points. One is the lower the predictability, the more frequent the touch points. So when you have uncertainty in a channel of sale or whatever, however you segment your portfolio, then you need to be looking at those and reviewing those more frequently. The other thing is that you need to tie in in a very timely basis where credit and collections connect. So if credit finds an alarming event or trend for a customer or a segment of the portfolio, they need to alert collections so collections can kind of turn up the volume. And the opposite is true, where on the collection side, if there's negative trends, there's increasing past dues, whatever, then it's time to alert credit to do a review. So that the tying of those two pieces of a credit department together in that fashion is very important in uncertain times, because Dave, you pointed out, things are changing rapidly. There's unexpected events that are just going to happen. The other point that I think you raised, it's really important for a credit manager, is you got to have your feelers out there. You have to be, knowledgeable about what's going on in the industries or business segments of your portfolio. You got to network. You got to benchmark. You have to understand what is going on the ground out there to bring some predictability to this. I'm a big proponent of traveling to your customers. I think that's a huge piece of a credit manager's job, but you have to understand the industry that you're in and what the dynamics are in order to make intelligent credit decisions. So I think those two things, Again, the higher the unpredictability, the more frequent tying credit and collections together, and also really being aware of what's going on in the world that may impact the creditworthiness and the payment cycle, of your portfolio. So we've talked about segmentation a little bit. And I think that's a very important thing, because different segments of your portfolio are going to react differently in terms of risk and collection. So, you can break it down by your product lines, again, channel of sale, the regions. One region may have a horrible storm that's going to impact part of your customer base, maybe a set of valuable customers. You have to be looking at it by region. And certainly there's country risk if you're an exporter, in risk in many forms that you have to, be aware of. Dave, is there any other comments you would have in terms of taking a portfolio and just kind of segmenting it and getting a better view of what you need to plan for?
Yeah, no, a couple things. So, yeah, you're absolutely right on the segmentation, and you need to obviously be segmenting it for risk. And I think you can use credit scores to do that with the smaller and mid-sized companies. Once you get above, the 100 million, maybe just above 50 million in sales companies, I don't think the credit scores are as valuable. So that's where your own analysis is going to be important. The smaller ones, the credit scores can help you out. And, after all those, there's lots of those, and they're usually less important. So you can rely on the scores there to rank your customers. And what's going to happen when you rank your customers, there's going to be marginal customers that you need to sell to survive in a recession. And that's where you're really going to have to do a lot of hard work. And, it's you're going to need to put the credit controls on them. Can we put them on a purchase money security instrument or some other security? What can we do to securitize these marginal customers and still keep them as sales, as profitable sales? Or, if we can't do that, what can we do collection wise? How close to zero past due tolerance can we go with these customers? And, one thing, actually, I'm writing an article on it, so it'll probably be out there by the time this podcast is on there, is that we need to keep the 80-20 rule in effect. But something that I've observed in consulting with clients is it's not just 80-20. It's what do we do with the lower half of those 80% of customers that only account for 20% of sales? Because what we really have is we have 20% of customers accounting for 80% of sales. The next 40% of customers are probably 15% of sales. So 60% of customers is going to cover your 95% of your sales. Then you have that lower 40%, the last 40% of customers. And you previously mentioned, can we put them out with a distributor and let the distributor worry about selling them? That's a great solution. We need to, I think, have almost zero tolerance with them. If they're going to pay us on time, great, we'll continue to sell them. If they're not going to pay us on time, I want them to pay on a credit card or some other payment facility. We have a lot of buy now, pay later type options for receivables finance. I want them off the portfolio because I don't want to have to be dealing with them. I want to be focusing on the 95% revenue customers.
David, I've been through this, and it's a very counterintuitive reaction to go and say, we need to offload this segment of our customer base. We don't have the resources to deal with them when they're not generating a profit or significant revenue for our company. We just don't have it. We're not going to bulk up our infrastructure to deal with a segment of our portfolio that doesn't bring any profit to us. It makes no sense. And I've been in situations, both as a practitioner and as a consultant, where the painful truth was told, and they offloaded that customer base because it just wasn't realistic. And I think you have to take a very sober view. The other thing you said,
Well,
Dave,
just let me add one thing.
okay.
Is the good news with that is I've seen companies that have offloaded them to distributors on a couple occasions. And so they didn't lose the sales because they're now selling to distributors. And actually it enabled them to increase sales because they're focusing on the more profitable set of customers. In both cases, it was very beneficial to the company. How did things work out for you?
It's a win. They're going to buy your product. It's just where they buy it and what it takes to sell to them. So those decisions have to be evaluated. It might be good in one case and might not be in another, but that's certainly something to consider when you're managing the portfolio.
One other thing too that happens too often in recession, and I've been through it, is that you're there in the credit department and your company says, oh, sales are going to be off, we're going to cut. And all of a sudden you're losing people from the credit department. And, I think it's short-sighted when companies do that, when they take people out of credit, due to a recession and just sort of general across the board type layoffs. Every department's got to share the pain. But, you've got to, when that happens, you've got to really look at your workload and make adjustments to compensate for it.
Yeah, that's a whole other topic, is convincing your people in your company that the credit department's a profit center and it shouldn't be touched and that sort of thing. But I was going to say one thing that you brought up earlier was securitization. And I think that there may be an attitude by people that if you get a UCC filing on inventory, for example, or you get a personal guarantee, that you're locked in, that you're going to get paid. It just isn't true. It isn't necessarily true, because what you have to do is take a very realistic view. If you're trying to securitize part of your portfolio, what does that really mean on doomsday? Are you going to have access to what you think you're going to have access to, or is the bank? Or are you dealing with people that do illegal things, and you're going to have to find them to get be compensated? So I think you have to take a realistic view. If you have a letter of credit, if you're exporting, or you use a standby letter of credit, which is coming back into vogue, it has to be written in a way that it's lock tight. You think about things like promissory notes. They have to be written very carefully, and those are excellent instruments. But when you think you really have something that secures your receivable, really, on doomsday, are you really going to have what you think you have? And I think that's a very important thing for credit managers to consider.
Well, yeah, and that's a great point, because if you're going to go do a UCC filing, a straight filing, there's probably going to be a bank ahead of you. So the question is, you got to take a look at the balance sheet and how much loan is extended, and is the bank going to then, if this company goes out, is everything going to be go to the bank? Is there going to be anything left over in terms of assets after the bank loans are paid off?
Right, but that's a very moving target, as we know. But the other thing is, I used to do this a lot, and I would get UCC filings. I would actually work with banks. So I would get a blanket lien, and I would subordinate my blanket to the bank, but I was ahead of all the other creditors. And I did this quite often. But then I found, okay, I think, well, I'm going to be able to retrieve inventory that I've sold them recently. I can't get the receivables. The bank's not going to relinquish the receivables, and they're all blended with other receivables that are coming in. So I'm looking to get my inventory, but where is it? It may have been transformed into a product embedded in a system, for example.
Is it commingled is the word, I think.
Yeah, well, I can't get it. I can't get it at that point. If it's sold, I certainly can't get it. So is it really there when I go to retrieve it? I had one customer that probably was a bit illegal, but we had a great relationship. And the day before he declared bankruptcy, we picked up all of our inventory, which we had a UCC filing on, and we were able to get that. But that's a rare that's a rare occasion. So you really got to take a realistic view of what's really there. And you have credit insurance. What does that really do for you? How long is it going to take to get paid? Do they have the right to give 2-year-old inventory back to you and ask for payment? There's all these considerations, when you're securitizing it. But it is important, if you can, is to develop for the weak sisters in your portfolio some form of risk mitigation. Start with the largest ones, maybe companies that are over their credit line, and really take a hard look at those. And then look at the weak companies where you're exposed. So what are you going to do to have some sense of security with those? And then look at the ones that their payment trends have deteriorated the most over a recent period, and maybe dive in and say, to continue to sell to you, we need this, and that. And then on the other side, on the positive side, you can look at companies that are great risks, but your credit lines are too low. And you go to your salespeople and you say, redirect your efforts, because we've analyzed this and there's capacity there. Redirect your efforts to these companies, because we're not selling to them to the capacity of a credit line that we could support. So you look at that. And also we all know, the best day of a contract is the day it's signed. After that, who knows, right? So look at large transactions, large new business, and determine, okay, it sounds great, maybe it's profitable, but what do I need to do to make sure that it's a good addition to my portfolio? Do I need to get some security on it, or organize payment terms in a certain way? So that's how I would look at it. When you're trying to figure out, what am I going to do about this? That's how I would look at the segments of my portfolio. What do you think?
We're on the same page. You want to look at the high risk and high impact people first, and those are high dollar as well. And you got to work your way down. You can only do so much. And so, start at the top of the risk pyramid. Where's the greatest exposures, which are the highest risks, and you take action on them. The other thing is, as we said before, this is an ongoing thing. There, even though we're in a recession, there's still going to be new customers, and you want to set the rules pretty strict with them. You want to get off on the right foot and make sure that that they can do that, they have they're credit worthy, and assuming they're credit worthy and you sell them, they better be paying on time, because there can't be that tolerance. One other thing that you're going to find out in a recession too is people are going to try to extend terms or request extend terms. What do you think about that? How do you approach that, Bob?
Extended terms, the longer it takes to pay, the greater the risk. So you have to consider that. It might be a good idea. It depends on the cash flow requirements of your company. It can gain you revenue. It can gain you some competitive edge. Money is more expensive than it was to borrow for your company than in the past. So there's kind of an equation, what is by the fact that I'm not getting cash in 30 days, but I'm getting it in 90 days, has an impact on the cash flow of my company and the need for my treasurer to borrow. So you really need to take a sober-eyed look at that and determine how it's eroding your profitability, how it's eroding your cash flow. But on the positive side, it could be something that gains you revenue and profit. So you really have to look at that. The other thing that we haven't mentioned in terms of a portfolio that is really important is your company is likely to borrow money, right, from a lender. What does a lender do? They come up with a lending formula, and they say, well, we'll lend you X% of your AR portfolio, and we'll lend you X% of your inventory. That's typical. And they come up with a formula, and then they come up with an interest rate. Interest rates are based on their cost of funds, their operating expense, their desired profit, and risk. So that's how interest rates are calculated. So when they're looking at your portfolio, if you have a very risky, managed portfolio, that formula for your treasurer is going to be pretty tough. But if you have an AR portfolio that is well managed, predictable, securitized where it needs to be, where the cash flow is managed very well, your collections are managed very well, then the treasurer is going to go to a lender and get a much more favorable borrowing rate. So this impacts not just the things we're talking about here, how you manage the portfolio, but how you manage a portfolio has a lot of other impacts for your company. So if you're offering extended terms, you're taking more risk. If it's not a sensible thing to do because of the nature of the company you're selling to, I would say don't do it. That's kind of my reaction to it, Dave. But there's a whole lot of other considerations that need to be made.
Let me just add one more comment on that. I've been in those situations managing a portfolio that was, the basis for our asset-backed loan. And I took a look at the covenants so I could understand, what they did, because it's not just a percent of your portfolio. It's a percent of the customers. I think that in my case, it was that were under 60 days past due, or at least 95% of their receivables under 60 days past due. So you start looking at those things and cleaning up the receivable. I was able to, just what you said in terms of managing the receivable better, we're able to add over $1 million in 1 month to the credit facility. And, we weren't taking advantage of the full thing, so it was lost opportunity there. So you can do those types of things as well in terms of managing it. So you need to take a look at the loan covenants and understand what they are when it relates to the AR.
Dave, that's really a great suggestion. Wish I'd thought of it. It's a great suggestion. I think we're coming to the end, so let's tie this together. What we talked about, this circles right back to, you got to have a credit policy that considers your company's strategies. The element that you discussed, Dave, is one of the things that impact that. So you got to have a coherent, well communicated, well thought out credit policy that you need to take another look at what's on the shelf to make sure that you're prepared for what we're going to be going through over the next year or so. And then you have to do an assessment, a very granular assessment of the companies in your portfolio, segment the portfolio, look at the risk. If there's parts of your portfolio that really shouldn't be there, then you need to take a very sober look with your colleagues and determine the best approach. And then when you securitize something, really take a good real world look at what you really will gain on doomsday. These are all doomsday instruments. So you have to look at, okay, what am I really likely to get? And then manage the credit and the collections in concert, and look at the time horizon of where a negative thing is going to happen with companies going into default, and kind of manage to that. And then just periodic reviews. And the other thing that we didn't touch on that I think is very important is how you communicate to all those who need to know what's going on with the portfolio. It's important to report so people understand what's going on with the portfolio and what your department needs to manage it, which may change over the next 12 to 18 months. So Anyway, I think that ties everything together, Dave. What do you think? I think that's about it.
I agree completely. I guess there would be only one other thing I'd add. And so if you're a credit manager and we're entering this recession, you need to do all this, you're going to have to delegate some of your credit and collection tasks to other people. You need to create time so you can do all this analysis and all this communication with the other departments properly and give it your due diligence. So get ready to delegate. You're going to have to give some things up to make more time to do this. And there's probably some parts of this that you can delegate to other people that they can help you out with.
You may need to hire, you may need to increase your bench strength and hire up. Now, the other thing that impacts this, we won't go into in this podcast, is CECL. So when you're looking at your portfolio now, you have to look at your portfolio and predict future losses. And that's going to take some time and analysis, and that's something you have to do. So,
and that goes into effect next year. So
yeah, so you go to your boss with this stuff, and it's the law of physics. There's so many reviews that need to be made. There's workload here, and you can actually, if necessary, you can justify increasing your bench and your bench strength. But with that, Dave, I think we need to close. It's been an interesting conversation as always with you, Dave.
Well, if we don't stop now, we'll just keep going.
Oh, absolutely. So with that, thank you very much. I hope it was an interesting podcast for everybody that stuck with us. And with that, we'll say goodbye.
So long now.
Thank you, everybody, for tuning in. If you want to learn more on the topic, check out Highako.com. That's HIGHAKO.com. We'll see you next time on the Credit Career Cast.